And welcome everyone to Live Stream Tuesday. We are live. And today I'm going to cover like a trade that I have been following for a long time. It is a juicy trade that looks ready to rip because there is an event. There is a catalyst, there is a reason, a purpose for why it happens this year in 2024 before a certain thing that everybody is paying a lot of attention to, and it is related to that. That is the election, which is coming up in November. So I'm not going to get into politics, but this trade definitely pegs off the election, and I'm going to explain to you why. I'm going to lay it out. I've definitely talked about this a lot, but in my previous videos, when I've talked about Fannie Mae and Freddie Mac, I've never been able to like this right here. This is the trigger. But now we have a trigger. Not only have a trigger, we have a very, very real prospect of why this can unfold, which sets up a machinery that I think is unstoppable. The stock market is telling us that it's unstoppable. Kind of like the news flow is telling me it's unstoppable. The fact that these stocks are mysteriously continuing to creep higher. And anytime like somebody's coming to dump shares, there's clearly somebody buying. I don't know. It's looking very good. So stay tuned this live stream. I'm going to lay it all out in all the details. But before I do that, and also I'm going to cover crypto miners. I did see before coming on that Bitcoin is now in the 70,000 range. I mean, it swings a lot. So maybe by the time I finish speaking, won't be, but want to cover crypto miners as well quickly. But I'm going to spend most of my time on Fannie Mae and Freddie Mac. And then, of course, we will take your questions. So line them up. But before I do all that, usual disclaimer, disclosure, which is that this live stream and all the content from ATG Digital Media is not investment or financial advice. It is presented to you as opinion, information, engagement, and entertainment. All ATG Digital content may contain errors, oversights, and mistakes. Please understand that investment operations, which are what? Buying or selling a stock, acting on anything that I talk about, our model portfolios, updates, crypto options, they have significant risks and can lead to the loss of your principal. You're not guaranteed to make money. In other words, the owners, employees, contractors of ATG Digital own, trade, transact, and securities are mentioned in this video, and all content from ATG Digital Media. We do not take money from companies or crypto promoters, etc., to recommend their stocks or crypto tokens. This is a listing of the free content. I got the Substack, which I encourage you to subscribe to. I actually recorded a Ball Man Speculating podcast yesterday, and I recorded another one this morning, which will be released probably tomorrow. And then, of course, I'm on YouTube right now. I'm there at least every Tuesday or thereabouts. Social media, I'm very active on X, which used to be called Twitter, but has been rebranded to X solely. Instagram from time to time. I put up some pictures. Facebook, Dean is pretty active there. If you are interested in subscriptions, they begin at $9.99 a month at atgdigital.media. And with that, let's get to the business at hand, which is after 16 years, wow. 16 years, two companies that totally dominate their business completely. We're talking about 75% market share. Essentially total monopolies, but have been controlled by the government since 2008 as a result of the global financial crisis. They're setting up to be released. And as they currently stand, they are not valued like regular financial companies. They are valued as if they are stepchildren. And there's a reason why. They trade on the over-the-counter exchange. They don't trade on a major exchange. They're not valued like they have a future. Why? Well, the government owns 79.99% of them. Not all of them. Doesn't own 100%. It's 79.99% of them. And there have been various different moments when these stocks seemed like they were going to just rocket up and sort of recover and get back to all of their value that they had before they were taken over by the government. But then something would come about. In 2012, the government decided, hey, you're making too much money. We didn't expect you to make this money. We're going to do, they call something the net worth sweep. In other words, they took all the profits that these companies were making again and said, oh, it belongs to us. And investors, shareholders, hedge funds, all kind of people went and sued the government. And that's been going on for, 12 years, and nothing has really happened. There have been moments when the politicians, when President Trump was in power, there were clearly plans to release these companies into the wild, reform them, set up a plan for them to re-IPO, work out how to get them extra money. And then, of course, Biden was elected and nothing happened. You want to see what all this looks like? Yeah, so it looks like this. This is let me scroll this up. This is a very, very, very long-term chart of Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac, ticker symbols FNMA and FMCC. I'm just going to take that back down because it's so big. The blue one is Freddie Mac and the black one is Fannie Mae. And what you can really say from this is that, well, they pretty much trade identical to each other. You'll see that big waterfall decline. That's in 2008. That's the global financial crisis. That's the government worrying that Fannie Mae and Freddie Mac, which are integral to the housing market, were going to go bankrupt. So they gave them a bunch of money, in exchange took 79.99%, restricted them from doing all kinds of things. Their stocks collapse. They stay in kind of collapse mode, and you can see at the lows in 2010 and 2011, from a high of nearly 75, something like that. Excuse me, I have a source, marginally dry throat. They get down to 30 cents. And then you see waves of optimism come through when, their businesses recover. The government did not expect that. The government didn't expect that. Their business recover, and people are like, hey, they're making a ton of money. So that gets bid up back to 5. Then their net worth sweep comes through and they confiscate all their profits. But then lawsuits come, and some of the lawsuits look like they might succeed. And so investors bid things higher, lower, higher, lower. Then President Biden gets elected. And then, people give up hope again. And it goes back to 30 cents again. And now today we are at approximately $1.50 for each. Right? I mean, it looks that with the recent peak was $1.99 for Fannie Mae, and I think for Freddie Mac it was maybe $1.70. I don't know. Either way, you can see this is a long, tortuous history for a set of companies that absolutely dominate their business. What do? They essentially buy mortgages, pack them up into bonds, and sell them to investors worldwide. That's the essence of what they do. And without that, there would not be enough money really for the housing. When you go to get your mortgage, you go to your local mortgage broker, maybe you go to your bank. They will be like, hey, do you conform to the standards set by these two companies, Fannie Mae or Freddie Mac? And if your mortgage does, then they can sell it to one of these companies who will buy it, pack them up into these bonds and sell them around the world. And now, the banks get their money back. The mortgage broker gets their money back. You can see it's like a little, like a washing machine of liquidity that keeps funding the housing market. And obviously, if you broke this, and someone had to make a loan, they would be like, oh, I've got to hold on to my mortgage for 30. I've got to hold on to this loan that I've made for 30 years. And most people just don't want to do that. So it's a very effective, clever solution, and our housing market depends on it. which is why people have always been willing to come in and be like, hey, there's something here. There's something here. It's obviously a large business. They generate a lot of money. They are profitable. They are now, today, it's the opposite of 2008. They are robustly profitable. They make a ton of money in the billions of dollars, but they are still 79.99% owned by the government, which is why these charts don't reflect their success. I mean, they are 5, 6, 7 times bigger than they were in 2008, but the stock prices don't reflect that because they are still 79.99% owned by the government. But very, very recently, a development has come up. And I wrote about this on X because it's a kind of like it's a very interesting kind of like thing that's going on. And it's, as dissatisfying as it is, which is that for 16 years, people have come up with all kinds of ideas as to why these things, the dream scenario is that they go back to whatever, $70. Okay, heck, if it went from $1.50 to 20, I think we'd all be like, yay, success, right? I mean, $70, but whatever it is, people have dreamed of all kinds of things. Okay, some court case is magically going to do it. Oh, obviously, President Trump was going to free them, but that didn't work out. Or some piece of legislation, Congress will come together and be like, we're going to work this out. None of that has worked out, but in election year 2024, there is something unfolding that I think is a better bet than all of that. And what is the better bet? It is politicians' self-interest. All right? So stick with me as I lay out the scenario for you. All right. I'm just going to scroll through my X post here. So a lot of this is what is going on today. So setting up the scenario here. So we've got today, as a result of the pandemic happening, the Federal Reserve cutting interest rates to zero, causing people to go flood the market and buy homes, and then housing prices going up. U.S. homeowners have an extraordinary amount of equity in their homes. An extraordinary amount. It is estimated, as this lays out, at between $182,000 to $299,000. Now, that doesn't mean every mortgage is there. Obviously, some have smaller. Maybe it's $30,000. Some may have $1 million. But whatever it is, it's an estimated $30 trillion worth of home equity across the US. Now, if interest rates were low, people would buy and sell, and they would unlock it, but there's really a lot of downside today because of the fact that we've seen interest rates jump in the mortgage market from 2% to somewhere between 7 and 8%. So people don't want to lose their low rate mortgages of 2 and 3%. They don't necessarily want to incur capital gains, especially if they have to go buy a new house at high prices and with a 6% mortgage, a 7% mortgage. So enter into the fray our friend Freddie Mac. And Freddie Mac is proposing buying home equity loans. And essentially what they are saying that they're looking to do is kind of standardize, formatize the second equity home loan market, the kind of the way that the first home loan mortgage market is. In other words, create standards. And, if you fit this certain thing, then they will buy your second equity loan that is initiated by a mortgage broker, initiated by a bank, and they'll pack it into bonds and they will sell it to investors. And going back to my post here, in my opinion, This is why this is moving both the Fannie Mae and the Freddie Mac common stocks and their preferred, right? And yes, it's Freddie Mac FMCC that has suggested this new business line, but I showed you the stock prices. They're essentially the same, and what one does, the other one will do. So it's guaranteed that Fannie Mae will line up to do the same thing as Freddie Mac. Now, if you are a longtime follower of these companies, as I am, I have followed these companies for 2 decades. In general, without getting super specific, the Democrats have generally been in favor for expanding the footprint of Fannie Mae and Freddie Mac, as you know, housing is a basic need, and they're like, well, the government should have some role in it. And the general position of Republicans has been, through Fannie Mae and Freddie Mac's history, which is that the private sector can handle this. They should handle it. These companies have this kind of like unfair monopoly. But in an election year, right? Remember, politicians' self-interest always comes number one. In other words, they want to get reelected, right? So homes are the number one asset. It's not stock, it's not crypto, it's not anything else. Homes are the number one asset for most Americans. A second equity home loan program that liquefied equity, $30 trillion worth, hundreds of thousands of dollars per mortgage, that's going to be pretty popular with Americans. I mean, I've got some equity in my house. I mean, and you know, I missed out on cashing out. I wouldn't mind tapping some of it. And we've got a generation, maybe many of you, baby boomers, reaching for retirement, nearing retirement, and you're like, well, I mean, I don't want to sell my house and then lose my low rate mortgage. I don't want to sell my house and have to pay capital gains. I want to sell my house and then have to find a new house that is trading for some crazy high price with a mortgage that is what? Double where it is. So there's a lot to be said for this program. In other words, it's going to be popular because of where things are today in the real estate market. But there is one problem. This conservatorship, this government ownership of these companies. This is a brand new line of business. We're not talking small, $30 trillion worth of equity. Currently today, second home loans are like, like $1 or $2 trillion, and it is a niche product. That is, you can get it maybe from your bank, from your credit union, but it's not done like in bulk. It's not done like the way like refinancing was done when interest rates were low. But that's what is going to happen if Fannie Mae and Freddie Mac get into this business of securitizing second home loans. They're going to need more capital. They're going to need more resources. They're going to need new people with different skill sets, new capabilities to run these businesses. They can't do it with the existing set. In other words, in some way, shape, or form, they're going to have to get out of like the shackles of conservatorship, of government ownership for this to happen. And the catalyst and the reason why this will get pushed forward is that, hey, Democrats will want to run on something that's popular. Hey, $30 trillion worth of home equity. We can get this out. And so they have an incentive now to press, whether it be the Biden administration, to press Treasury, which controls the regulator for Fannie Mae, and be like, hey, you got to do this. Freddie Mac has proposed this, and this is a great idea. We should do this. And being that it's popular, I bet a number of Republicans will support it, despite their historic opposition to Fannie Mae and Freddie Mac. I'm betting that they will. Why? Because it's popular. That they'll be like, well, I don't want to oppose this. Equally, being that this is going to be a competitive election, Democrats will also want to like, well, this might be our chance. Like if we lose control of the Senate, or if there's a power shift, Republicans may be like, maybe this never happens. And then, maybe that, even that the Fannie Mae and Freddie Mac rules in housing, post-conservatorship, in whatever shape the Republicans might take it, might not happen. In other words, this is their chance. In other words, we got to get this done before the election, because who really knows? And obviously it would help to have this program to run on, to talk about people, especially with inflation being one of the biggest concerns. They're like, hey, but like this is something good that we have done. And in my opinion, after 16 years of whatever, betting on lawsuits, hoping that a president would, do something by administrative fiat or some legislation. No. What makes things move is going to be, politician self-interest. A competitive election is going to make our politicians ditch conservatorships because it helps them. That's the bottom line. Now, for us as investors in Fannie Mae and Freddie Mac, if I'm right, obviously I can't guarantee that I'm right. I can't say for certain, but having followed this is the most real, most like, oh yeah, I can see the logic of this. I can see the rationale for this. I can see the reasoning for this. You don't have to, like go on some wild, like, oh, this is this complicated. Nah, there's going to be an election. Yeah, it's going to be competitive. People would like something popular to offer their constituents. Yeah, so I mean, we've owned Fannie Mae and Freddie Mac Common for a very, very long time. We have owned the preferreds for a slightly less long time. And I put up the ticker symbols previously. I'll put them up again. Now, FNMA is the Freddie Mac common stock. FMCC is FNMA is Fannie Mae common stock. FMCC is Freddie Mac common stock. And I'm just putting up one of the ticker symbols for the preferred. So these preferreds are like bonds almost. They, prior to government ownership of these companies, they would pay dividends every quarter, and they have a par value. In this case, the ticker symbol for this preferred Series T is a $25 par value, which means that, remember, a bond is essentially a loan. So theoretically, if Fannie Mae and Freddie Mac were released, this preferred stock, along with all the others, and there's a vast series of them, like I'll show it to you. There's a vast series for each of these companies. Here is the Fannie Mae preferred stock list. You can see there's a lot of them, and you can see that they in success mode, theoretically, they would go back to paying their dividends. They would be valued something like bonds. They would their upside would be capped by their par values of either $25 or $50. And you can see here as well, this is the Freddie Mac. They've got all these preferred stocks. So there's two sets of ways to play this. I mean, yeah, it's still a speculation. There's no guarantee of it. But I'd have to say, in my judgment, in my opinion, as someone that has owned the preferred since 2008, I bought a small amount, just like, oh, hey, what if this like turns out they were trading for, I don't know, 50 cents for a 25 par. I'm like, yeah, I'll buy some. And then I bought some more over time. And more recently, since leaving Banyan Hill and where I could buy things that, I had in ATG portfolios, I own the Fannie Mae common. I mean, but both of those will essentially, the upsides will be quite similar because they're going to mirror each other. As you have seen by those charts, they're essentially going to do the same thing. So if I were to put odds, I would say for the first time, like in 16 years, I would give this better than 50-50 odds. I wouldn't bet the farm on it. I wouldn't go all in, and I wouldn't plan, a permanent vacation, quitting your jobs. But if it's right, I mean, where could these go back to? Let's see. I mean, let's go back and look here. Yeah, I mean, they came from 70 all the way to 30 cents. And today, these companies, at least, it's a little bit complicated because it's unclear, like, is the stock market at $1.50 valuing these companies for the 20% that is still public, or is it the 100%? Either way, we'll get some of the answers a little bit as information is released, and I'm certain that information is getting out there. You don't see a rise from 30 cents to $2 because people are dumb. I mean, there are smart money investors that are in Fannie Mae and Freddie Mac. Bill Ackman was a big billionaire hedge fund dude. I mean, he's held on to Fannie Mae and Freddie Mac, yeah, I think for like 6 years or something like that. He's still in it. And he says, like, hey, if these things ever normalize, they're going to be absolute rocket ships. Where could it go? I mean, I'd say at minimum, we'd go back to $5 or $6 and would hold their value there. But I think that would just be the start. I mean, again, not investment or financial advice. I mean, in success mode, long term, yeah, I mean, if they're free, then they're back to being private companies. These companies, if you look at their revenues, you look at their assets, you look at what their profits would be under normal conditions. I mean, they should go back to where they came from. As crazy as that sounds, that is a possibility, not a guarantee. It's a possibility. So what's the bottom line here? Well, after 16 years, this speculation based on something that happened 16 years ago that many people don't remember very well, but it's still alive. There is a catalyst, there is a trigger to make it happen in the year 2024 related to the election, related to where the real estate market is. And yeah, you can bet on the common and then you get potentially unlimited upside. I mean, obviously from $1.50 to get, heck, 5 would be great. 10 would be unbelievable. To actually have the prospect of going to whatever, $20 or $30 or maybe longer term 70. I mean, that's insane territory, but it's possible. I'm not guaranteeing it, it's not saying, but it's definitely possible. If you're doing the preferreds, then the upside is capped depending on the par value of the preferred, $25 or $50. But even there, if the interest rate is below current interest rates, maybe they keep it open and it'll go back to par value and they'll pay their dividends. Again, sounds insane, sounds crazy, but it's a possibility. And the key factor here is that all of that at present anyway is not priced in. Why is it not priced in? I don't really know. I'm guessing that if I'm coming to this set of conclusions and assumptions, other people are. The market is suggesting that, yeah, that there's some number of people that are like getting interested in this and they're bidding it higher. We've seen, while you don't have the chart prices of the preferreds up, they've also been going up as well. And they're like getting to 1-2 year highs. So there's a sure sign that that people are interested. Some number of people, I believe, are seeing the same things that I have. And so, hey, who knows? I'd want a shot, right? I mean, to make 5 times your money, 10 times your money, maybe 20 or 30 times your money. I'm always interested in making big money. And so this is why I'm like, okay, this is what I'm seeing. I want to put it to you. Check it out. I recently did a special report for our Purple Tier members of ATG Digital. So if you want to check that out, if you're a Purple Tier member, you can go there. All right. Before I switch to questions, I want to bring up a Substack that I wrote on crypto miners yesterday. And by pure luck, I want to believe it's skill, hey, we're seeing crypto rocket higher today. So I just want to cover this because I've gotten a lot of questions from all of you. Paul, what's going on with the crypto miners? What's going on with the crypto miners? And as I've explained on this channel and I laid out in this Substack, which is that crypto miners, from my experience with them, they kind of they tend to anticipate new highs. They don't necessarily always go up and down with Bitcoin, but they anticipate new highs. And the fact that we're seeing crypto miners today starting to move higher is telling me that Bitcoin is setting up to make a new high. Bitcoin made its last all-time high on March 14th at 73,802. and it's been 81 days since then, which is a very long period of time. I've seen analysis that says, like, I mean, after all-time high, like generally you get one within, like, I don't know, 45 days on average. So we're well beyond that period. In other words, we are due. And crypto miners are a leveraged play. They are a leveraged play on Bitcoin and on crypto. The demand for Bitcoin ETFs is rocketing higher. We just had a ETF approved in Thailand. We had just had an ETF approved in Australia. Others are going to come. As price goes higher, the number of people coming in are just going to increase. And as Bitcoin price goes higher, you will see, as happened in the last cycle, you can see. So this is a chart of Marathon Digital, which at the time was the biggest crypto miner. You can see, yeah, Marathon Digital did far better than Bitcoin. So the leverage in the operational leverage, the financial leverage in crypto miners means that you'll get better performance with greater volatility in the crypto miners than you will in Bitcoin itself. And also you'll see that post the peak, you'll also want to sell it somewhere near the peak because it crashes down, and this is, in other words, a trade that is cyclical that you definitely have to be mindful of as you think about putting this on. We added 2 more Bitcoin miners to the diamond tier portfolio at ATG Digital. We did one on, I think I did one on Friday, did one on Monday, and we might do one more. I mean, we already own Marathon Digital and we already own CleanSpark, but we add 2 more and maybe we'll do one more, and that'll probably close it out. All right. That is the prepared material for today's live stream. And now let's go to questions that folks have put up. Okay, we've got this one here. Any questions that you have? Do I know anything about ADMA stock? Let me put this up and see. I usually just say that sounds like a biotech that I have known in another time. ADMA Biologics. I do vaguely remember what they used to do. If I don't know what is going on here, obviously the stock has taken off like a rocket ship from $3 to $10 and is making 5-year highs. When I last remember it, they made like a medication to deal with a side effect from another drug, but I have not looked at it in a long time, so I don't want to give you an answer without having a longer chance to look at it. John says, what are my latest thoughts on Zoom and Teladoc? Their cash flow is good, but their growth has significantly slowed. Yeah, I mean, when you have a one-time super surge in growth without like a follow-on that goes on, and then you have a reversal in the environment that created the surge, which is what? I mean, the onlineification of everything as a result of the lockdown. They're clearly going to have to work through this period and to generate growth on top of whatever they generated is going to take some time. Meanwhile, the stocks are back to where they were almost at the IPO level. In other words, on a value basis, I mean, their revenues have surged. They've obviously pivoted to being cash flow positive. In other words, these are incredibly cheap, waiting for investors to do what they always do, which is investors like to buy at high and rising prices associated with growth. And so at some point in time, we are seeing, the U.S. workplace being transformed by work from home, by artificial intelligence, by any number of catalysts that are going on. And these are only going to go forward. We have an enormous shortage of medical personnel, everything from doctors to nurses to physician's assistants. We are going to have to lean into technology that we currently have to deal with these shortages. So Teladoc is just a matter of time before their utilization rises, the number of things for which they're used for rises. So it's really now a waiting game. As I like to say, people like to sell at low prices and buy at high prices. So if you believe in the prospect of more online everything, which is, what does Zoom do? Essentially takes all of our communications that you previously might have used the phone for and turns it into something that where it's like this. I can talk to many people online, whereas before I might have to set up a conference call. You sit in a conference room, you bring all be together. Instead, the modern world of telecommunications, you want video, you want to be in your house, and you want to just be able to go there and do it. And that's what Zoom does. Are we going to have less of that? Not in my opinion. I mean, I've got the Zoom account. We have 2 Zoom accounts at ATG Digital by ourselves for all of our communications. Imagine, big companies, as people continue to spread around the country, around the world. I mean, and with Starlink, you can work from anywhere, Elon Musk's satellite company. So the prospects are good, but obviously it's not here. And the market is always valuing growth 12 to 18 months ahead. That's when you get a premium for it. So you can either see it as like these stocks are down, or you can see it as these stocks are low in price with, extraordinary runways of growth, right? I mean, these are fairly young companies, 10, 15 years old, and they have, 20, 30 years worth of growth ahead of them. At some point in time, people will look back and, whoa, these stocks were incredibly cheap, and the prospects were as good. A comment from Anthony Perry, who's a regular live stream attender. Thank you. Rashad says, hi, Paul. And you said Elon asked NVIDIA to ship the processors to XAI instead of Tesla. I mean, we get so caught up in day-to-day news. I mean, remember, Tesla's a large company. XAI is a startup. I mean, is any single piece of news going to destroy Tesla overnight? Is it going to damage this company irreparably? I mean, I've followed stocks for 15, 20 years. I've never known any single piece of news to be that material. I'm pretty sure that Elon's not dumb. It's not stupid. I mean, he still owns 10%, something like that of Tesla. Would he want to destroy that value by somehow just sending all the processors that they have to XAI? I doubt it very much. But, it does make a cool news cycle clickbait. It's like, hey, Elon's going to destroy Tesla. I doubt it. Julie says hi. Hey, Julie. Thanks for attending. Another hi from Magic Bullet. Leo Line Dogs have moved the major indices. You expect us to decouple from them soon? We have not moved with the major indices if you measure in years. Maybe if you're measuring in days, I can tell you we have not moved. I'm very, very aware of that, both from my account balances and from tracking the GBC 100, which is our index of innovation companies. We are not tracking the major indices, maybe over the last 2 days. But, 1 or 2 days, it doesn't mean anything. I mean, unless you're a very short-term trader, which we are not. So we are definitely not tracking. If we're tracking the major indices, our stocks would be at all-time highs, which is where, the vast majority of the stocks that dominate, for example, the S&P 500, they're all within 5 to 10% of their all-time highs. Our stocks are not. So we are definitely not tracking the indices. So we are decoupled from them. We would expect that this decoupling is eventually going to reverse, where our stocks go up and the S&P 500 stagnates and does very little, because the performance is dominated by essentially 7 to 10 stocks. I just did this analysis for my Ballman Speculating podcast, which is that the top 10 stocks in the S&P 500 represent 34% of the index. The top 10 represents 34%. So that's 34. More than 1/3 is the top 10. The top 100 represent in excess of 70%. I believe it's nearly 72%. So we're in the, in the nobodies, in the invisible category. The remaining 400, in other words, represent almost nothing. They could double and triple and they wouldn't move the S&P 500. That's where our bets are. So, I mean, the market has made the bet with what is big is going to continue to get going bigger and bigger and bigger. And we're like, no, we think some of these small companies are eventually going to become, bigger and bigger. And there's a lot of room, because if the top 100 represent nearly 72%, yeah, I mean, companies 101 to 500 represent what? 0.01, 0.03, 0.04. They could double and double and double and double for years and years and years to come. And not only that, I mean, I know many of these companies. These companies have real technologies, real products and services, and they're young. I mean, unlike the companies that dominate the S&P 500, their technologies are young. They're still in the process of really like going on that enormous growth runway. And it's not priced into their stocks, so they're cheap. So that's a long answer of saying I expect us to do well, and I expect the S&P 500 to struggle if we're measuring out in years. Steve says, please go ahead and tell me if you covered this earlier. What is the possible downside going forward for Fannie Mae and Freddie Mac? Would you anticipate roughly to stay constant? The downside is what you've seen. I mean, if everything that I'm saying is wrong, I'll go back to trading at 30 cents, I suppose, which where at some point people will still be willing to pay that price for the potential that, if it doesn't happen this year, then it happens next year. Maybe when Trump is elected, they'll go back to their official policy. I mean, President Trump, when he was president, had put Fannie and Freddie on a path to be released. If he's reelected, he said that that's what they'll go back to. So there's no way to exactly know. But if you go and look at like where people are willing to buy and where people are willing to sell, says 30 cents to about $5 seems to be the range. I think I answered that price-wise. What is my current opinion on Mankind and its long-term potential? I'm very, very optimistic on Mankind Corp. Sometimes I get confused. I do so many videos. I did a special report for ATG Digital Purple Tier members, laying out the upside in Mankind Corp based on their Tyvaso DPI royalty arrangement, their Afrezza clinical trials, which I believe is going to expand the market for their fast-acting inhalable insulin, and then for their clinical pipeline, which is made up of very low risk but potentially high revenue candidates of previously approved drugs that they can just put on their inhalable platform. So I am very optimistic long term for MNKD. Julie asked, maybe talk a little bit about ARKK. I mean, ARKK is the best proxy, if you will, for the smaller companies, the has-beens, the invisibles, the unknowns, the anonymous, the 400 companies, if you will, in the S&P 500 that are still in innovation, in opportunity and growth. But these are the companies that are pursuing innovation. They are going for it. And among these companies are going to be some game changers. Obviously, Tesla is in there. Bitcoin is in there. Our stocks, I mean, there's a lot of commonality between ARKK and what we do. And for now, Kathy Wood and ARKK, people are calling her dumb and stupid and idiot and all these things. And, I suppose the same can be applied to me. But I think, Kathy and I, we're going to have the last laugh. As I like to tell my friends, he who laughs last laughs the most. Because why? Well, I mean, I can go look at what companies, whether it be Coinbase, whether it be Block, whether it be Zoom, whether it be Teladoc, whether it be CRISPR, whether it be Moderna. I can go and look at these companies and say, look, these companies have extraordinary capability. They have also extraordinary potential. In other words, they're still working on stuff. These are young companies, right? These are 10 or 15 years old, right? They are still in their growth like mode, right? And their stock prices have, almost to a rule, have all gone back to as if like they have lost like all of their business over the last 5 years. I mean, they're trading at 2019 prices. Meanwhile, their businesses have developed, their business models have developed, their technology has developed, their products and services have developed, but the stock market is acting as if like, yeah, this is all like, yeah. So my experience that this always resolves in the favor of the value that's been created. In other words, yeah, I mean, these companies have extraordinary amounts of revenue. They're trading cheap. So the environment will shift. What will it take to shift? And you never exactly know, people. I mean, the easy one to say is interest rates, and maybe it's something else. But whatever it is, something comes along that shift the environment, and suddenly people are like, oh, these companies are great. But we are human beings and we are driven by emotion. So we want high prices. If these stocks were flying high, everyone would be incredibly excited about them, right? But they are flying low. So they're like, these are crap. When will they ever do anything? Oh, Paul, you need to give up on this. You were dumb to do it. Okay, that's okay. I have lived through a few cycles myself, and we will stay here and we will see who laughs the most. So I am, like Kathy, ARKK is obviously has done very poorly over the last several years, but I would not count it out. Leo says, yeah, I mean, stocks rise and fall every day. I mean, you have to measure it something other than day to day. At minimum, you're gonna have to use a quarter or two, and this is why we created the GBC 100. And when I last checked, I haven't done a quarterly update, but we will do one at the end of June. We were ahead from its start date against the S&P 500. So I don't think that's true. That that the innovation companies are actually doing worse. Does Roku stock have any chance of increasing the second half of 2024? Well, I mean, Roku is one of the growth innovation blue chips. It will clearly, what gets people excited is not business results, it's the stock price, right? So I'm expecting in the second half of this year, between slowing growth in the legacy economy, rising growth in the digital economy, which Roku is part of, I'm expecting a shift, a transition to happen, which will cause Roku price definitely to go up in the second half of this year. Certainly, nothing's changed. If anything, their business position has only improved. There is no competitor. They are a monopoly. I mean, who else can you name that does what they do? I mean, almost. I don't have a TV and I haven't owned one for a long time, but every person I know has at least one Roku in their house, and they use it all the time. They are the gatekeeper for all digital video. It's an extraordinary position to be in, and the stock is acting as if they have like a nothing business. So Ali says, how much Fannie Mae stock if they release? I don't know what you're asking, but I think I laid out the prospect, which is like, well, I mean, if we simply go right to where they've gone in a range, every time there's been the prospect of release, $5 to $6. If it actually gets released, then, a long-term upside could be back to where they came from, $50, $60, or somewhere in between. TTS. Do you predict there would be an up move for Uber? Well, Uber is one of the very few growth stocks that actually has made a new high during this growth bear market. So there's a very little sign that of people wanting to sell Uber. Uber seems to be one of these few growth stocks that even I'll call regular investors seem to have warmed up to, because they pivoted to cash flow production and sort of profits a little bit earlier, and also their business was a little bit more mature, and they were able to show the things that people wanted a little bit earlier, and so it's owned by a lot of regular investors. The one issue that comes up with Uber is, well, what's going to happen when robo-taxis arrive? And there's a difference of view on this, and some people maybe get bearish on that. I personally think that Uber is perfectly set up for robo-taxis. They'll just buy Teslas and run robo-taxis on their network. That's what I expect them to do. And I don't think that Tesla will be a complete monopoly. We have at least one competitive company that is working on autonomy that's out there. It's actually the company that Uber sold their autonomy division to, Aurora Innovation. So long term, I mean, Uber will keep going up. I mean, it's a fairly young company that's still got robo-taxis are going to be a catalyzing event for them as well. How much of Tesla's near 3-year decline has to do with politics? In my opinion, zero. It has everything to do with how excited people were in 2021 and bid up Tesla after it had already been bid up. It was I think when we put it in, it was 700% lower, because in the ATG Digital Silver tier portfolio, I can still see we have a gain of like 600 or 700%. In other words, as Model 3 scaled up, people started to price in more and more optimistic assumptions. And then there was a crazy period in 2021 where people just, went all in for the stocks that we were in because the growth rates were huge. It has everything to do with price. From high prices, people get incredibly excited and bid things higher to even higher prices. And they don't really care about the business. They don't really care about like, oh, well, historically, businesses with these growth rates, normally don't trade for very long at 30 times sales or whatever the case may be, or growth is impossible to be sustained at such high levels for a period of time. So then investors get disappointed, they sell out, and at low prices, people are like, I don't really want to own it. I'll come back when it's going up. So it has everything to do really with prices and human psychology. But Tesla, in terms of its business, has improved. Model Y is the best-selling car in many parts of the world today, including the United States. I mean, they have an Optimus program, which didn't exist. Autonomy is nearly 85% complete. I'm a personal witness to this. So, but people don't get excited by those kinds of developments. Price is what drives our satisfaction. And as price gets bid up, people will start to get excited about Cybertruck and all of these things. So that's my view. Julie says, did you say Uber will be some kind of network hub for semis? You mean trucks? Uber, right now they have two businesses, essentially moving people and then moving things. They do have a trucking business. And I do believe that, they've essentially got a very large computer that is very good at efficiently at sort of like managing transportation resources. And the two places that they can do it, three if you add food delivery, which is a small but reasonably, decent sized business. It's moving people, food delivery, and then it's trucking and transportation. Julie says, I've heard that interest rates will be effective. Tesla price will go up. We need a cut in September to see that happen. Well, as I was writing in my Substack, I think it was last week, the digital economy is clearly counter-cyclical to the legacy economy. So, but interest rates will be cut because of weakness and problems in the legacy economy, which then benefit the digital economy. So if interest rates get cut, it will definitely stimulate purchases of more EVs, and it'll also push the valuation of long duration companies, which then will drive more investment, which will drive more innovation companies. So it's counter-cyclical to legacy companies. So yes, I guess I have to agree with you. Yeah, I'm not worried about Elon. Elon's got plenty of money, and I'm more worried really about losing him. Where will we replace a brain like Elon? Somebody that can effectively create a new industry in transportation and EVs, have the guts to pursue autonomy and full self-driving, dream of moon colonies and colonizing Mars, and not just dream of it, actually work with people to have rockets that can go into space and then come back. And then come up with everything from ideas from Optimus to tunnels to implanting chips in the brain, satellite companies. We are lucky to live when this man is alive. And to me, it seems like the most obvious thing that you'd want to own Tesla stock, which is the only way to get in on this man's incredible brain. There's no other way. We can't invest in SpaceX, unfortunately, and none of the other companies are public. But you can get in on EVs, autonomy, Optimus robot, Tesla semi, Cybertruck by being in Tesla. Leah says, I read your book, enjoyed it very much. After 6 years with you, I still learned a lot from it. Has much changed for you from the time you wrote it? Um, I haven't read the book in a while. I think a lot of the forward-looking themes are playing out. It was, and there's nothing major there. I mean, if I could have seen that there was going to be a pandemic, there was going to be a huge cut in rates, then a huge jump in rates, and a huge jump in inflation. There are lots of things, obviously, I didn't anticipate. But mostly, I think the thing that I might have said is like, well, I mean, the path to the big gains, yeah, is rockier than I would have pictured at the time I wrote the book, because at the time we were in the era of low interest rates and zero interest rates, and at the time it didn't look like there was any catalyst or trigger to get us out from there. But one arrived. That was the pandemic. It essentially removed the sense of fear that was there in markets, which has been replaced by greed, and then it's also extinguished all the fear that people to hoard cash. No one hoards cash anymore. And so now we have inflation. So those things have changed. So if I was writing a second version of the book, there would be like, okay, a post-COVID, post-pandemic, where are we going over the next 20 or 30 years? And now it would still be many of the same technologies. I think space would be a bigger theme in it. AI would be a slightly different theme. We can start to see what industries will go first, how they'll impact it, what the impact's going to be by country. So it would be a continuation. I don't think there'd be much of a reversal. Julie says, go vote for Elon's compensation package before June 7th. You could win a tour of the Texas Gigafactory. I have voted my shares, Julie. I have voted my shares for Elon. Elon is, like I said, we are lucky to live when this man is alive. We are lucky to live where he's willing to, I don't know how many hours a day Elon works. Is it 16 hours, 18 hours? I know. Tesla, SpaceX, Neuralink, Boring Company, XAI. Yeah, I mean, no one is perfect. No one's, going to meet everyone's approval. But yeah, I mean, on net, I'm thrilled that Elon lives today. I'm thrilled to be a Tesla shareholder, and I'm proud to vote for his compensation package. And I'm 100% on board with Julie on this. Josh, by the way, is a friend. So, but I appreciate the comment, Josh. And with that, we're coming up on the 1 hour mark. I'll see if there's any last questions on Fannie Mae. Going once, going twice, going thrice, on crypto miners, on Bitcoin, on Ethereum, because it does look like we're setting up for new highs, and that is coming soon. All right. With that, I think I'm going to close this live stream up. Thank you for attending. I should be back next week on Tuesday, and I'm seeing no questions, so I'm going to say goodbye.